Hello students and welcome to EPG Pathshala. I am Dr. Shefali Nagpal from Bhagat Phool Singh Mahila Vishwavidyalaya. Today we are going to talk on the module Exchange Rate Determination under the paper International Business Operations. After completing this module, you will be able to learn foreign exchange rates, foreign exchange trading, exchange rate mechanism, exchange rate determination, and exchange rate theories. In the previous modules, we have studied what is foreign exchange market, referred as forex or currency market. It is a globalized platform or an institutional structure where the currency of one country is converted into that of the another country. It is a market in which trade between the currencies are made. In other words, it is a market in which national currencies are bought or sold against one another. A foreign exchange market refers to buying foreign currencies with domestic currencies and selling the foreign currencies for domestic currencies. Thus, it is a market which claims the foreign money. Repeat. Thus, it is a market in which the claims to foreign monies are bought and sold for domestic currency. The foreign exchange market in terms of value of transaction is the largest market in the world and works round the clock. The BIS Triennial Central Bank Survey reports turnover of 5.3 trillion per day in April 2013. Interbank quotations. These are the most common way that professional dealers and brokers state foreign exchange quotations, and the way they appear on all computer trading screens worldwide is called European terms. The European terms quote show the number of units of foreign currency needed to purchase $1. For example, if we need to purchase $1 against a Canadian dollar, it will be Canadian dollar is 1.5770 US dollars. An alternative method is called American terms. American terms quote show the number of units of US dollars needed to purchase 1 unit of foreign currency. For example, the reverse will be $1 is 0.6341 Canadian dollar. Clearly, the two quotations are highly related. Define the price of US dollar in Canadian dollar to be also defines the price of Canadian dollars in US dollars to be. And for example, if we need to convert the US dollar into Canadian dollar or Canadian dollar into US dollar, we need simply to multiply the rate of one currency to the number of units. Then it must be that S into the Canadian dollar per unit US dollar is equal to 1 divided by S US dollar per Canadian dollar, because Canadian dollar is 1.577 US dollars is equal to, it will be now 1 divided by US dollar, the rate was 0.6341 per Canadian dollar. These rules also apply to forward rates as well. We will denote an outright forward quote using the following notations. Direct and indirect quotations. A direct quote is a home currency price of a unit of a foreign currency. An indirect quote is a foreign currency price of a unit of home currency. In US, a direct quote for the Canadian dollar is US dollar 0.6341 per Canadian dollar. This quote would be an indirect quote in Canada. Bid and ask quotations. Interbank quotations are given as bid and ask. Now, what is a bid? Bid is the exchange rate in one currency at which a dealer will buy another currency. And what is ask? Ask is the exchange rate at which a dealer will sell the other currency. Dealers buy at the bid price and sell at the ask price, profiting from the spread between the bid and ask price. That is, bid is less than ask. Bid and ask quotations are complicated by the fact that the bid for one currency is the ask for another currency, as it is explained below. Foreign exchange trading and SWIFT. In an interbank foreign exchange transaction, no real money changes hand. All transactions are done electronically through SWIFT. Banks undertaking foreign exchange transactions simply transfer bank deposits through SWIFT to settle a transaction. SWIFT, as we have already defined in the previous module, is the Society for Worldwide Interbank Financial Telecommunication, is a cooperative organization headquartered at Belgium. The SWIFT network connects around 8,300 banks, financial institutions, and companies operating in 208 countries nearly. SWIFT provides a standardized messaging service to these members. As and when two counterparties undertake a transaction, SWIFT transports the message to both financial parties in a standard form. As the foreign exchange market is mainly on OTC market, SWIFT message provides some kind of legitimacy to the transactions. The following line capture summarizes the activities at SWIFT. SWIFT is solely a carrier of messages. It does not hold funds nor does it manage accounts on the behalf of customers, nor does it store the financial information on an ongoing basis. As a data carrier, SWIFT transport messages between two financial institutions. This activity involves the secure exchange of proprietary data while ensuring its confidentiality and integrity. For every participating member, SWIFT assigns a unique code, and this code is used to transport messages. Now, after understanding what is foreign market, let us now understand foreign exchange rate and how it is determined. What is foreign exchange rate? It refers to the rate at which a country's currency are exchanged for currencies of other country. In other words, it is the price of one currency in terms of another currency. For example, if the value of $1 in Indian rupees is 45, then the exchange rate of $1 is 45 Indian rupees. Thus, foreign exchange rate indicates the external value of a country's currency. It also allows the purchasing power of a country's currency in terms of currency of another country. Let us now understand how we determine the exchange rates. The rate of exchange being the price of national currency in terms of another. It is determined in foreign exchange market accordance with the general principle of theory of value, that is, by the interaction of forces of demand and supply. Thus, the rate of exchange in the foreign exchange market will be determined by the interaction between the demand for the foreign exchange and supply of the foreign exchange. Demand for the foreign exchange. Foreign exchange is required by the citizens or the government to make the payments abroad. This results in the demand for the foreign exchange. These payments are recorded in the payment side of balance of payment. The demand for the foreign currency arises due to the following payments. One is import of goods. Consumer as well as capital goods are imported from the other countries. Foreign exchange is demanded by the people who import these goods. Higher the value of the imports, higher will be the demand for the foreign currency. Second is import of services. Services rendered by the other countries, which include banking, insurance, transport, communication, educational services, etc., are also required to be paid in the foreign exchange. Others are dividend, interest, and profits earned. In India, many foreign firms have invested in the various sectors in which results in the outflow of the foreign exchange on account of the dividend and profits. On other hand, government and Indian firms has also borrowed from the foreign countries, which result in payment of the interest. Import of services. Services rendered by other countries, which include banking, insurance, transport, communication, educational services, etc., are required to be paid in foreign exchange. Dividend, interest, and profits are to be paid. In India, many foreign firms have invested in various sectors, which result in outflow of foreign exchange on account of the dividend and profits. On other hand, government and Indian firms have also borrowed from the foreign countries, which results in the payment of interests. Unilateral payments, donation, gifts, etc. are one-sided payments without corresponding returns. Such payments create demand for foreign exchange. Export of capital, repayment of debt, purchase of assets in foreign countries, etc. all require foreign exchange. All the above categories of the payment abroad result in aggregate demand for the foreign exchange. The total demand for the foreign currency is inversely related to exchange rate. The higher the exchange rate, the demand for the foreign currency may be low. Supply of foreign exchange. Supply of foreign exchange in a country comes from receipts of its exports. The receipts of the foreign currency are recorded in the receipt side of the balance of payment. The main sources of supply are exports of goods, which constitutes a major source of supply of foreign exchange in a country. Both size and price of exports depends upon the demand of elasticity of goods. In India, the manufactured items occupy the top positions in the exports. Exports of services. In recent years, this source is gaining lot of importance. Export services in various fields, tourists coming from the other countries, transport, communication, insurance, etc. are important services which earn and supply foreign exchange. Other are dividend, interest, and profits. Indian firms have invested in various sectors in foreign countries. Thus, there is inflow of foreign exchange on account of dividend and profits. Indian institutions also have lent money abroad, which result in receipt of interest. Unilateral receipts. The payments which are received in form of remittances from domestics working abroad, donations, etc., they form the part of foreign exchange supply as well. Other is import of capital like foreign investment, direct and portfolio, repayment of debts by the foreigners, all increase in the supply of foreign exchange. All the above categories of receipt from abroad result in aggregate supply of foreign exchange. The total supply, like the supply of any other commodity, is directly related to price, that is, the foreign exchange rate. At a higher exchange rate, the supply of foreign currency may be high. Exchange rates. Transactions in the exchange market are carried out at what are termed as exchange rates. In foreign exchange market, two types of exchange rate operations takes place. They are spot exchange rate and forward exchange rate. Now let us understand what are spot exchange rates. When foreign exchange is bought and sold for immediate delivery, it is called as spot exchange. It refers to a day or two in which two currencies are involved. The basic principle of spot exchange rate is that it can be analyzed like any other price with the help of demand and supply forces. The exchange rate of dollar is determined by intersection of demand for and supply of dollars in the foreign exchange market. The demand for dollar is derived from countries' demand for imports, which are paid in dollars, and supply is derived from countries' export, which are sold in dollars. The exchange rate determined by market forces would change as these forces changes in the market. The primary price makers buy, that is, bid or sell, known as ask, the currencies in the market, and the rates continuously change in a free market, depending upon demand and supply forces. The primary dealer, that is, bank, usually quotes two-way rates, that is, buy and sell rates. For example, let us understand the bid. The buy rate of $1 is 45.50 Indian rupees, and ask, which is the sell rate of $1 is 45.75 Indian rupees. The bank is ready to buy $1 at rupees 45.50 and sell it at rupees 45.75. The difference of 0.25 is the profit margin of the dealer. After discussing the spot exchange rate, now let us discuss the forward exchange rate. Here foreign exchange is bought or sold for future delivery, that is, for the period of 30, 60 or 90 days. There are transactions for 180 and 360 days also. Thus, forward market deals in contract for future delivery. The price of such transactions is fixed at the time of contract. It is called as forward rate. Forward exchange rate differs from the spot exchange rate, as the former may be either be at a premium or discount. If the forward rate is above the present spot rate, the foreign exchange rate is said to be at a premium. But if the forward rate is below the present spot rate, the foreign exchange rate is said to be at discount. Thus, forward exchange rate may be at the forward premium or at the forward discount. For example, an Indian importer may enter into an agreement to purchase US dollar 10,000 60 days from today at 1 US dollar at the price of rupees 48 Indian rupees. No amount is paid at the time of agreement except for usual security margin money of about 10% of the total amount. 60 days from today, the importer will get 10,000 US dollars in exchange for rupees 4,80,000, irrespective of the spot exchange rates that will be prevailing on that date. Now let us see what are the factors that influence the foreign exchange rate. These are the interest rates, degree of speculation in the foreign exchange market, inflation rate, foreign investors' confidence in domestic country and currency, economic situation of the country, political situation of the country, balance of payments position. Let us also see some of the theories which determine the exchange rates. Many theories have been written in respect to the main determinant of future exchange rates. Although the majority of these theories give adequate reasons in order to explain what actually determines the rates between the currencies. Below, we will refer to the main theories regarding the determinants of the exchange rates. First is supply and demand. The exchange rate, just like any other commodities, determine its price responding to the forces of demand and supply. Therefore, if for some reason people increase their demand, that is, there is a shift in the demand curve from D to D1 for a specific currency, then the price will rise from A to B, provided the supply remains stable. On the contrary, if the supply is increased, that is, there is a shift of the supply curve from S to S1, the price will decline from A to C, but provided the demand remains stable. It is shown in the figure A. Any excess supply, that is, above the equilibrium point, or excess demand, that is, below the equilibrium point, will increase or decrease temporarily foreign currency reserves accordingly. Finally, such disequilibrium situation will be eliminated through the pricing. For example, the market will do it for itself. As you can see in the figure A, where the demand and supply for the foreign currencies are shown, where P shows the price or the exchange rate, Q shows the amount of the currency demanded and supplied, A, B, C, they show the equilibrium exchange rates. If there is a shift in the demand curve from D to D1, when there is a shift in the supply curve from S to S1, the prices that changes from A to B or A to C according to the forces of the market. Purchasing power parity theory. As by the definition, the purchasing power parity states that using a unit of a currency, let us say 1 euro, which is a purchasing power that can purchase the same goods worldwide. The theory is based on the law of one price, which argues that should a euro price of a good be multiplied by the exchange rate, for example, euro in exchange of US dollars, then it will result in an equal price of the goods in US dollars. In other words, if we assume that the exchange rate between the euro and the US dollars states at 1 by 1.2, then goods that cost 10 euros in the European Union should cost US dollars of 12 in the United States. Otherwise, arbitrage profits will occur. However, it is finally market that through the supply and the demand force accordingly the euro and the US dollar prices to the equilibrium point will decide. Thus, the law of one price will be reinstated, as well as the purchase power parity between the euro and the US dollar. Inflation differentials between countries will also be eliminated in terms of their effect on the prices of goods, because the purchasing power parity will adjust to equal the ratio of their price levels. More specifically, as stated in their books, the currency of the country with the higher rate of inflation will depreciate against the other country's currency by approximately the inflation differential. In conclusion, it can be argued that the theory, although it describes in a sufficient way the determination of the exchange rates, is not of good value, mainly because of the following two disadvantages. Firstly, not all goods are traded internationally. And secondly, the transportation cost should represent a small amount of the goods worth. Third is balance of payment approach. The balance of payment approach is another method that explains what factors determine the supply and demand curve of the country's currency. As it is known for macroeconomics, the balance of payment is a method of recording all international monetary transactions of a country during a specified period of time. The transactions recorded are divided into three categories: the current account transaction, the capital account transaction, and the central bank transactions. The aforesaid mentioned categories can show a deficit or a surplus, but theoretically, the overall payments, the balance of payment as a whole should be zero, which rarely happens. As stated earlier, a currency price depreciation or appreciation, that is, the change in the value of money, directly affects the volume of the country import and export, and consequently, a likely fluctuation in the exchange rate can add to the BOP discrepancies. For example, a likely depreciation will increase in the value of export in the home currency terms, that is, larger the export demand elasticity, the greater the increase. Conversely, the imports will become more expensive and their value will be reduced in the home currency. The larger the import demand elasticity, greater will be the decrease. The J-curve effect illustrates that in the short term, a depreciation of the currency can initially worsen, that is, from A to B, the current account balance before it improves its position, that is to the figure B. This is due to the low price elasticity of demand for imports and exports in the immediate outcome of an exchange rate change. It is shown in the figure B, where on the one side balance of payment and on the other side represents the time. The monetary approach. In this approach, attention is given to the stock of currencies in comparison to the willingness of people to hold these stocks. According to the monetary theory, exchange rates adjust to ensure that the quantity of the money in each currency supplied is equal to the quantity demanded. Both quantity theory of money and purchasing power parity have been used in support of aforementioned theory. The QTM states that there is a direct relationship between the quantity of money and the level of prices of goods and services sold. In other words, more money equals more inflation. Another approach is the portfolio balance approach. The portfolio balance approach takes into consideration the diversification of investors' portfolio assets. Diversification is a technique that attempts to reduce risk by investing both among various financial instruments and across national borders. To mention just a few, for example, here below we consider a combination of domestic and foreign money and domestic and foreign bonds, the implication of which are illustrated in the following figure C. Portfolio balance approach, on which we have taken exchange rate at the x-axis and domestic interest rate at the y-axis, and it represents the portfolio balance approach. Both M and B lines show combination of domestic interest rates and exchange rates. The upward line M is in agreement with the equilibrium in the money market, and the downward line B is in agreement with the equilibrium in the bond market. Point E, which is the transaction of M and B, represents the combination of the interest rates with the exchange rate that gives equilibrium to both money and bond markets. What the theory argues is that an increase in the money supply will lead to depreciation of the exchange rate. The extent of depreciation depends upon the slope of the curves M and B. For example, if we consider an increase in the domestic money supply, we will anticipate that a lower interest rate and or higher exchange rate can only absorb the excess supply, which in turn will result in the reduction of bonds. To this end, the line M will move to the right and line B will move to the left. Let us understand what is arbitrage. It is an act of simultaneously buying a currency in one market and selling it another to make a profit by taking advantage of exchange rate differences in the two markets. The arbitrages are confined to two markets only. It is called as two-point arbitrage. If they extend to three or more markets, it is called as three-point or multi-point arbitrage. Those who deal with arbitrage are called arbitrageurs. A spot sale of currency when combined with the forward repurchase in a single transaction, it is called as currency swap. Swap rate is the difference between spot and the forward exchange rates in currency swap. Arbitrage opportunities may exist in foreign exchange market. Suppose the rate of exchange is US dollar. $1 US is 0.50 in US market and $1 US is equal to 0.55 in Indian markets. Then an arbitrager can buy US dollar in the US market and sell it in the Indian market and get a profit of 5 per dollar. In today's modern world, well-connected and advanced market, arbitrageurs can spot it quickly and exploit the opportunity. Such opportunities vanishes over a period of time and equilibrium is again maintained. For example, let us see there are two banks, Bank A and Bank 2. Both are offering their bid and ask prices. Bank A of 50.50 and 50.55. And similarly, the Bank B is offering 50.40 and 50.45 US dollars. The above rates are very close. What the arbitrager will do is to take an advantage. He can purchase 1 lakh US dollars from Bank B at 50.45 and per dollar and sell it to the Bank A 50.50, thus making a profit of 0.05 per dollar. The total profit would be 1 lakh multiplied by 0.05, which comes to 5,000. The profit is earned without any risk and blocking of the capital. Arbitrage and interest rates. Interest arbitrage refers to differences in the interest rates in domestic market and overseas markets. If interest rates are higher in overseas market than in the domestic market, an investor may invest in overseas market to take the advantage of interest differential. Interest arbitrage may be covered or uncovered. Now, what is uncovered arbitrage? In this system, arbitrageurs would take a risk to earn profit by investing in high interest bearing risk-free securities in foreign market. His earning would be according to his calculation if the currency of the foreign market where he invested does not depreciate. If depreciation is equal to the difference in the interest rate, the investor would incur no losses. However, if depreciation is more than the interest rate, then the arbitrager will incur losses. Now let us understand what is covered arbitrage. So students, let us now summarize what we have learned in this module. The foreign exchange market is a mechanism by which a person or firm transfers the purchasing power from one country to another, obtains or provides credits for international trade transaction, and minimizes exposure to the foreign exchange risk. A foreign exchange transaction is an agreement between a buyer and a seller, and that a given amount of one currency is to be delivered at a specific rate for some other currency. A foreign exchange rate is the price of a foreign currency. A foreign exchange quotation or quote is a statement of willingness to buy or sell at an announced rate. The foreign exchange market consists of the two tiers, the interbank or wholesale market or the client or the retail market. Participants include bank, non-bank, foreign exchange dealers, individual firms conducting the commercial and the investment transaction, speculators, arbitrators, central bank and treasuries, and foreign exchange brokers. The transactions are affected either on the basis of the spot basis or the forward or swap basis. A spot transaction is for an almost immediate value date, while for a forward transaction is for a value date somewhere in the future. Quotations can be classified either as the European and American terms or as a direct or indirect quotes. A cross rate is an exchange rate between two currencies calculated from their common relationship with the third currency. Arbitrage is the act of simultaneously buying a currency in one market and selling it to the other to make the profit by taking the advantage of the exchange rate differences in the two markets. Thank you.